We also visited the headquarters of CapitaLand in Singapore. Now, CapitaLand is one of the most diversified and one of the biggest real estate investors and developers here in Asia. We asked them about their view on India. The company wants to double their investments in the India market from $5.7 billion currently to approximately $11 billion by 2028. Diversification is a key strategy for them, and India plays an important role. Listen in as we speak to Andrew Lim, the Chief Operating Officer of CapitaLand. Andrew, thank you so much for being with us here on Global Lens, our new program.
It's a pleasure. Welcome.
What's your view on India right now? Singapore has always been the largest source of FDI into the country. What's your sentiment on India?
We remain very excited about India. India is one of our core markets. We started investing in India 30 years ago with the development of our first IT park in Bangalore. We see a lot of positive trajectory stemming from positive regulatory changes, structural changes, capital market, the opening of the capital market in India. We have had a lot of good feedback and investor interest from our capital partners. And our business, our core business in India through our 4 principal verticals continues to grow. So in a nutshell, we're very excited about the business in India that we are building.
As we walk in your office, and it's a very swanky building, I must say.
Thank you.
I must get a sense from you as to how much investments do you have planned for the India market, say till about a 5-6 year horizon?
We currently have about 8 billion of funds under management, again, slowly, painstakingly built up over 30 years. The ambition, as I mentioned, is to more than double that in the next 3 to 5 years. So by 2030, we would like to double that to more than 15 billion in funds under management, which gives you a sense of our optimism, but also the confidence that we have that the Indian market is ready for such investment.
Right. Are there certain projects or acquisitions that we could hear of in the next 12 to 18 months, possibly, as far as India is concerned?
Absolutely. If we execute well and a little bit lucky with good fortune, otherwise we will not be able to hit our doubling of FUM. We have built up a business principally on 3 platforms. The traditional IT business parks, which has done phenomenally well and remains our anchor business. We also have a thriving logistics platform that we've built up. And we have started most recently a data center funds business with the investment into 4 data centers in 4 separate cities. So these are our core pillars which will form the anchor and the basis of this doubling of funds under management. We are also interested in beginning to invest into other interesting and exciting sectors such as renewable energy and credit.
Okay, I would also like to ask you about what can be done in terms of making India a more attractive FDI and business destination, or as a place to do business. If there were certain things on top of your mind or recommendations, what would those be, Andrew?
Well, candidly, I will have to say that India's not been the easiest place to do business in. I would say bureaucracy is probably a big one. Tax has been a common cause of complaint and frustration for many investors. But I think what has changed substantially in the last, say, 2 to 3 years is that the government has recognized that these are impediments to making India as a favorable and premier destination for global capital. And we have seen real change, concrete change in tax reform, land reform, enforcement rights, and the ease of capital to both come into India and be repatriated out, which are key hallmarks of a premier investment destination for global capital partners. So if we can continue with this momentum and demonstrate to capital partners that this is here to stay, I think all the ingredients are there to continue to promote India as a premier destination for global capital.
A lot of tariff uncertainty around the world right now. Whether tariffs will stay or will they go. There is now a court ruling in the US as well. How is that impacting your business and plans going forward?
It certainly isn't helping or making things easier, but it's safe to say that the core fundamentals of real estate investment remain. First of all, you need to be localized. Real estate is a very local business, so we believe that as Asia Pacific's premier asset manager, we need to have teams on the ground to be able to continue to originate good real estate opportunities. And then you have to marry that up with access to capital partners, with these structural, capital, tax efficiencies that capital is seeking to have, because they will have multiple destinations that they can choose to deploy their capital in. I would say that India's relative ranking as a preferred investment destination has risen significantly over the last few years. And I think that allows us to position India and allows India to position itself again as a relatively preferred destination amidst all of this uncertainty with respect to tariffs and geopolitics and so on and so forth.
Is this current geopolitical situation making you hold back on future investments?
It is making us be much more circumspect and careful and disciplined, which is what our capital partners are expecting from all responsible asset managers. So we hear the phrase that never waste a good crisis. I think that is absolutely true. Crisis begets disruption, and disruption begets opportunities. So our capital partners are looking for thought leadership, looking for good ideas to put their capital into, and good ideas are coming. But one should not rush into such ideas. One, you have to do your homework, you have to understand the landscape, understand what could go wrong, for which there are many such sources. And so I think that's incumbent on us as a good fiduciary for foreign capital, for domestic capital, to ensure that we make proper decisions for all of these opportunities which we know are going to come.
Could this lead to a slowdown in the real estate sector, investments in the real estate sector, not just in Singapore, in Asia, in India?
I think to your earlier question, we should be more circumspect. We should not be rushing headlong into investments. We should be studying them carefully. The nature of the investment opportunity might differ, and you could have different pockets of investment opportunities. These could be structural and systemic, such as the need for greater housing, the need for data centers as we digitalize ourselves, but also give rise to lots of opportunistic and more tactical situations as disruption inserts a layer of uncertainty and distress, if you will, between buyers and sellers of real estate. So you've got sort of two ends of a barbell that are both equally compelling, provided you do your homework and you have access to capital partners that share your thought leadership in these sectors.
Right. You've been reducing your exposure to China. What's your view on the China market as of now?
China is, we remain long in China, and China is a long game for us. So yes, there are structural geopolitical challenges in the short term that require us to take a hard look at our overall exposure to China, but we remain long and constructive on China. And the key, again, is to marry the right opportunities, which are still there, with the right capital pools who remain interested and see what we see insofar as China is concerned. And that's just the process of slowly decoupling from capital partners who no longer wish to be in China, and marrying opportunities with capital partners who want to be in China. And there are many such partners.
Yeah. Could you give us a sense as to, right now, what would be your sentiment, what would be your outlook on real estate growth in the Chinese market? Because that clearly has a ripple effect on other economies as well.
It does, but as you've heard before, China is in the midst of its own strategic and pivot into a domestically driven economy. China, as you know, has always traditionally been an export-led economy. They are now realizing that they have to sort of rely much more heavily on their own domestic economy to ensure that growth is perpetuated. And so that actually changes the way that they look at real estate and the way we should look at real estate in China, as well as thinking about the right capital partners that will be invested and are vested in such changes. So I would say that it's not so much a reduction or a less reliance on real estate, but it's the way that investing in real estate is going to change in China, and we must change along with it.
All right, Andrew Lim, thank you so much. It's a pleasure having you here on Global Lens on CNBC-TV18 Prime, talking about the CapitaLand story, about your plans to diversify and the importance of India as a market for you as well.
It's my pleasure. Thank you.
On that note, we take a short break.